Good afternoon, everyone, and welcome to today's webinar, No More Excuses, Leveraging Loan Pricing for Better Results. We're so happy to have you on this afternoon or morning, depending on where you're calling in from today. Before we jump into the content, I just wanted to roll through some quick housekeeping items. First, you will receive a copy of today's slides in an email from me after today's session. However, if you'd like to follow along as Daryl's moving through the presentation today, there should be a handouts portion of your GoToWebinar toolbar where you can grab the PDF version of those slides right now. Additionally, if you have any questions throughout the presentation, we encourage you to use the Q&A panel or the chat area, whichever one will make sure they get to Daryl, and we have some time set aside at the end for questions, but also if something pertinent pops up during our presentation, we'll try to jump in with those questions as we go. If we aren't able to get to your question live on air, we'll be sure to follow up afterwards. Real quick, we always like to include a disclaimer, a slide in our webinars. We may make forward-looking statements made relative to publicly available data. However, this is not meant to advise any specific course of action. So a little bit about Abrigo, if you aren't familiar with us, formerly Bankers Toolbox, an anti-money laundering and fraud detection software provider. SageWorks, kind of a lending and credit risk platform. MST, an allowance software provider, and then Farron, a risk management solution provider, all came together to become Abrigo in 2019. So feels like yesterday, but we're actually closing in on 3 years old here, and we're super excited about that. Our goal is to enable American financial institutions to support their communities through technology, through fighting financial crime, growing loan and deposits, and optimizing risk. And with over 2,300 financial institutions today using our solutions, we're excited to make big things happen for you and your clients. So if you have any more questions or need more information, please feel free to head to abrigo.com. So a little bit about our presenter today, Daryl Matea. Daryl is a senior advisor at Abrigo, where he was formerly from Farron, and he manages and built and helped out with a lot of our deposit and loan pricing services over the years. He's been part of the banking industry since well before my time, but I'm so excited to have him on today. And he also is a professor at the Graduate School of Banking at the University of Wisconsin. And has a graduate degree from Wisconsin as well. So we're super excited to have him on, as I said, today. And with that, I'll go ahead and pass things over to Daryl.
Thank you, Thomas. We're going to switch presenters on you here. So now we should have a different show with we got the new one up there, Thomas?
Yep, looks good to me.
All right. Oh, it doesn't like my window positioning. I'm sorry, folks. I got to go back to what I was planning to do here a little bit differently. Okay, there we go. No, still doesn't like it. I haven't been on this platform for a few weeks, so I'm going to switch gears and do this differently. My name is Daryl Matea. Thanks for taking some time today to listen to this presentation on loan pricing. I'm a senior advisor, as Thomas mentioned, at Abrigo. I spend a lot of my time helping institutions set loan and pricing guidelines, practices, and strategies, and evaluating those things, when they get them in place. We also, in addition to looking at software, we really spend a lot of time looking at, are we getting the results we want? And I'm going to share a lot of that information and knowledge with you today. When I started my career in banking, it was during a period of relatively high liquidity, and it seemed like every discussion we had in those days was oriented around the investment portfolio. All the CFOs in those days thought they were going to make their difference in banking by getting the investment side of the institution to perform really well. And I found that quite odd. I did learn how to read a balance sheet in college, and I noticed that the balance sheets had more loans on them than investments. So why are we spending so much of this time on investments? Well, part of that was because at that time, the banking industry was just becoming deregulated. Until 1980, it was illegal to charge interest on a checking account. So there was a practice of kind of doing things the same way in lending that I think steered some of that thinking towards other parts of the balance sheet. And I still see evidence of that today. I still see evidence of, yeah, well, we're just kind of going to leave the lending practices alone because they seem to be working okay and they seem to be doing okay. And so a lot of that decision making, which I call settling, for lack of a better word, is something that we like to challenge in our advisory practice at Abrigo. Now, there's way too much more to cover in loan pricing in general than we can do in 45 minutes. So here's a quick picture of how I'm going to cover this today, roughly in 4 chapters. So I'm going to tell you a story, and if the materials I'm going to go through, the slides, think of them as illustrations in the story. I'm not going to read the slides. I'm not going to explain them to you. What that means is I hope my story pretty much lines up with the materials that you're looking at, but it doesn't always, because sometimes I get off a little bit or start thinking of something that happened last week. We update this material all the time. So as we go through this and you have questions or you would like me to define something or expand on something, please put a question in, please use chat. We like that or we appreciate that. Thomas is going to make sure we look at those and respond to them. And we're going to leave some time, of course, at the end to deal with general questions. But I'm going to move through some things relatively quickly to get to my real focus today, which is how can we make a difference with tools around loan pricing and loan practices. All right, so chapter 1. We're in an income squeeze today. It's because rates are low, right? So we're going to take a deeper look at this squeeze because I think it's really interesting. So one of the things we do regularly at our practice at Abrigo is we look at performance difference between different institutions based on call report data. We load all of the reported data that you all report into a big database, and then we can put together peer groups, an analysis of how one institution compares to others or compares to peers. So one of the things I do regularly is I've got different groups defined, and I have these 2 groups you see reflected here called Midwest low performing and high performing banks. And our definition when we do this analysis of a high performing bank is consistently earns an ROE above 15-16%. That happens to be represented by 234 institutions. Low performing institution, consistent ROEs below 10%, which is a higher number of institutions. And then we're going to take a look in a minute at what some of the other differences between these groups are. Now, the reason that I've got this particular group chosen is specific. There's no credit unions in here because while we have a lot of that data in our peer database, we don't yet have the ability to combine the credit unions and banks, report data and call reports in different fashions. And our software team's still working on being able to combine those together. So we can't match up those groups. Plus, of course, the balance sheets are somewhat different between a typical credit union and a typical bank. The other reason I look at a region like the Midwest is there are still a surprising number of regional differences in practice, in yields, in what people make, what kind of fees you can get here versus what you can get on the West Coast. They vary enough where for this purpose, it's better to focus on one region where the lending practices in particular and some of the pricing practices are somewhat similar. The reason I use ROE for a measurement difference is because I think it's a better overall measure of the total risk-reward trade-off that you're making on a regular basis in a finance institution. And this is true whether you're a bank or a credit union. ROE reflects how well you are deploying and earning results from capital. And capital is one of the things we use as a primary risk management tool. So these are my 2 groups of institutions. You can see these ROEs for the high-performing institutions bouncing around a little bit. That's simply because this is quarterly data, and that changes, particularly when you get to the end of the year. Institutions pay dividends, they adjust their they adjust their income statement to get your end of year results to look a certain way and so forth. But you can see they're consistently pretty good. So what are the other differences between these institutions? Well, let's start with net interest margin. Guess what? Our high-performing institutions in orange have higher net interest margins. Remember, the definition of net interest margin is the difference between income we're earning on earning assets, loans, and investments, minus what we're paying for our funding, for our deposits and our wholesale funding. And this, by the way, is where most of you make most of your money. If you're a typical community bank, it's probably 70 to 80% of your total income comes from net interest margin. Again, early in my career, it bothered me how much time we spent looking at non-interest sources of income expense. You do that for obvious reasons, because sometimes it feels like that's all you have control over in the short run. But look, this is our biggest lever. This is where we learn or earn most of our income, and look at the differences. Now, we all took a 30 to 50 basis point bath on net interest margin when rates dropped last year, right? And when rates go up and down, net interest margin is not parallel, because the rate of change in rates on the asset side and a little bit liability side vary. When rates drop, rates don't drop as fast on liabilities as they do on our earning assets. Same thing when rates go up. They go up quicker typically on assets than they do on the deposit side. So we see that difference right there. Now let's break down net interest margin, because again, it's the difference between what we're earning and what we're paying for our funding. Let's look at cost of funds between these two institution groups. Virtually identical. And of course, these costs are dropping. And these, part of our squeeze problem is these are dropping so fast, we're getting towards the basement. Now, this data reflects, cost of funds is somewhat historical measure. I know institutions that are approaching 20 basis point run rate for their current cost of funds. So we're getting these down about as low as we can go. You know, how much more room do we have to earn income by reducing these costs? You know, we're probably doing about as well as we can, but the key thing here is there's no difference in these. Well, there's a little bit of a difference in these groups between high performing and low performing. Let's take a look at where the real differences are. I like to focus on yields on earning assets, in particular yields on loans. Look at the differences here between high performing and low performing. And by the way, this is consistent in any particular high and low performing groups we look at. We always see this difference. Now you see this chart jumping around a lot in the pandemic, and that is because of PPP. They get almost to about the same rate, down close to 5% for my two groups here. That's a distortion. That's a distortion because we had all these PPP loans going on the books, which you can see are coming back off of the books, and these yields are going up again. And look at how much the difference is opening up between my high performing and low performing group, back to 20 to 25 basis point difference already just in this call report data. So this is one reason high performing institutions do better. It's because they generally earn a better yield on loans. There's a second reason high performing institutions do better, something else we see consistently. It's basically that they make more loans. This chart is a basic liquidity ratio, loan to deposit ratio. High performing institutions have higher rates of lending to the overall asset size. In other words, their investment portfolios are somewhat smaller. Again, this is consistently true. So they're deploying more of their earning assets on the lending side. Okay. Chapter 2, how do loan models really work? So I want to start this discussion by asking how we really do pricing as an industry. And by the way, I do this all the time. We're going to ask you a version of this question in a minute, but I ask institutions all the time, well, how do you really do loan pricing, and what is your pricing mechanism? And look, I can summarize it pretty quickly. What we usually do is kind of follow each other, and we do that in a couple of different ways. In other words, we price off the market. So here's a picture of pricing off the market. I like this picture. I know it's kind of hard to see here. This is the prime rate through time, historically through time, from when it was tracked back in the 30s until now. And you can see it jumps all over the place. It topped out at 21.5% back in the high rate period of the 80s. The thing I like to point out about the prime rate, we price off of this, right? Some of our loans. Let's remember the definition. It is the rate that the 10 largest, the Wall Street Journal version, the 10 largest banks in the United States charge to their highest credit quality customers. Okay, are you one of the 10 largest? No, this isn't you. Do you loan to these high credit quality customers? No, you don't. So this rate reflects something that has really nothing to do with your balance sheet or your lenders, yet we price off it all the time. And one of my questions I always ask people, is why do you think that is? And if you have the time, go ahead and throw into chat, why is it that we price off of these things that don't have a lot to do with us? I mean, there's some very good reasons, but I always, I like people to tell me what they think the reason is, because we don't have to. We actually choose to do this, okay? We choose to do this primarily via convention. Now, we also do one other thing. Some of you are going to say, well, yeah, we don't price our loans directly at prime. We add a spread. Aha, that's right. You add this thing called a credit spread. Okay, so here's another view of what I'm going to call risk-based pricing, which is really kind of the convention we have in place today. We take some group of loans, we set some kind of best rate, and actually what we do is we look to the market for some kind of base rate or starting rate, whether that's prime or LIBOR or SOFR or the best rate you can get from Fannie or the best rate in your market for loans. And then we risk adjust them, right? Isn't this part of our regular practice? We risk adjust those loans. Well, how do we do that? Well, here's a picture of one way we do that in the mortgage industry. This is a recent Fannie Mae loan level price adjustment matrix, which says if you're going to make a loan, you're going to assess two elements of credit risk, loan to value range and credit score of that borrower, and you are going to adjust the base rate by this number. And if I have a 719 score and I'm doing an 80% LTV, I'm going to pay 1% above the base rate. Where's that 1% come from? That's a pretty round number, isn't it? It's a very round number. And the answer to that question is these numbers are kind of made up. They're made up because we know we need to do risk-based pricing, but we're not exactly sure how to do it. So we just kind of take what we've got available. Now, a lot of you do risk-based pricing in a lot of different ways. You do some version of this, but it raises a lot of interesting questions. Do some of these loans have twice the credit risk of other loans based on this one parameter here? I know if I were a 739 credit score and I had 70% LTV in my loan today because my house value has gone up so much, I'm not happy about having to pay that extra 75 basis points of rate if I knew about this. You know, a lot of consumers don't know about this. So we're going to do a real poll here quick. Thomas is going to set this up. And the poll question is, I'd like you to vote for what you think best describes what your current pricing methodology is. In other words, what process do you currently use to set and adjust rates as you go through the practice? And again, there's very likely a combination of these in many institutions. So pick the one that you think is closest to what you do, and I'll be interested to see what these will report. We'll give this another 30 seconds or so, Thomas, and then I assume these get shared with everyone. Do you know offhand?
Yep. I'm
Okay.
just watching the folks answer right now. And once we slow down here in a few seconds, I'll go ahead and turn these results around. So if you're not seeing that poll question, it should be in that same toolbar where you can enter questions and grab that PDF handout of the slides. All right, looks like we got about 80% or so of the audience, Daryl. So I'm going to go ahead and close it, and let's share the results here.
And where do I see those? Do you see them?
Yep, I can see them. So it says, what method do you think best describes your loan pricing methodology currently? Yep. We've got 41% saying they price off the market with a periodic review of those rates and spread. Yep. Second place is an internal system with 28%. And then another 25% say they look up to lenders, and then a real small percentage say they use a vendor.
Okay, so it's pretty consistent with what I observe out there, which is, yeah, you have some sort of market-based rate that you're looking at, and then you're pricing off of that with some kind of spread. That's essentially the most, not surprising to me, the most common technique that we see out there. But there's more going on to this, and that's what makes it tricky today. So when you put a modern loan pricing mechanism into place, it comes with a model that does some assessment stuff for you. So I'm gonna talk about models for a few minutes here. This picture is an essence of how all models work. Now, at first, this looks relatively straightforward. A loan has revenue, you charge interest, and you have fees, right? And then it has expenses. And so if we can just simply figure out revenue minus expenses, we can calculate what we're going to earn, what the value is. It's a little more complicated than that. Let's just take revenue for a second. How much interest do I earn on a loan? Well, what if it's a variable rate loan? We got to adjust for that. So we have mechanisms for doing that. How much interest do I earn on a line of credit when I don't know what the utilization rate is going to be? So we've got a cash flow issue. And in fact, we need to know when we configure loan models, we need to get a pretty good description of how the cash flows behave. And part of valuing and pricing loans is understanding not the terms of the loans. The term of the loan is actually almost useless. 5 years, 7 years, open-ended. What we really need to model are the cash flows. So a good loan model has to do that. It's not too hard to do, but we have to go through some configuration to figure that out. I have clients who have one category of loans that has a 44% line of credit utilization, and in a different sector, they have an 85% utilization of lines of credit. Double the income just on that difference, okay? So we gotta do some of that. Then we got the expense side. Now that looks fairly straightforward. You know, we have the cost of funding loans. Well, that's not too hard to look up. I just showed you a number where we can calculate that right off the call report data. We're gonna talk about that in a minute. That doesn't quite work. We have costs of making loans. Good cost accounting processes can figure those out. There's a couple of issues there that we have to deal with, like do I consider all costs, the costs of the salary of the CEO, or do I consider marginal costs, what it costs me simply to run the account opening process or to run the lending function? So you make some decisions there, but we can come up with those numbers. Then we have some other expenses. You see that thing there called credit risk allocation. We have credit risk costs. What do I mean by that? Well, let me describe it in more general terms. We have uncertain cash flows with every single loan we make. Category 1 is credit losses. We don't know which loans are not going to perform, but those are real cash flows. That is principal and interest we are not going to get back. So how do we factor that in? Well, the basic way we factor that in is we make some assumption about how much principal we're going to lose, okay? That's not trivial, and that's not terribly easy to do in a few minutes. We got to figure that out. We've got another category of uncertain cash flows, which are prepayments. Early payments. We all had a lot of prepayments when the pandemic started for a bunch of different reasons, including people getting stimulus checks, people refinancing their mortgages, taking cash out, and basically cannibalizing our auto loans and our credit cards. Credit card balances went way down because we paid them down. So those were unplanned, unscheduled cash flows that are unpredictable. So we got to try to figure those things out when we're setting up loan models. And that takes a little bit of work. Actually, where we spend most of our time in configuring a loan model is we can get bogged down in setting up this part of the analysis. You know, where do we get this information? What do we do with it? And furthermore, we've got some other things going on here. We have this thing called interest rate risk. We're going to talk about a couple times today. How do we deal with interest rate risk when we look at a loan? How do we figure out? We have to deal with time value of money. Some of our cash flows aren't going to come for 5, 7, 8 years from now, so that's worth something different than it is today, okay? So we have to go through this process, and this is where a lot of the time is initially spent in building a model. But the reason I show this screen is because one of the things it's helpful to understand when you put a pricing methodology into place is you're not pricing rate and term. Pricing loans is pricing risk. Remember, think of our basic mechanism for loan pricing today. We take a base rate like prime and we add a quote unquote credit spread in there. Well, that credit spread number in a lot of institutions in practice is really a bunch of things, right? And here's a breakdown of some of those risks that we're trying to price. Credit risk. We know there's a difference between a $150,000 loan we make on my property, which is probably worth $450 in my nice inexpensive Midwest neighborhood, versus a $150,000 loan we're making to a new business that has no, cash flow history, right? Those should have probably different credit risk allocations. The current practice we use to do that is not ideal at all, Because if we go back and look at recent historical losses, there aren't much. Delinquencies are at an all-time low and doesn't tell us anything. The good news there is we're headed for the correct solution, which is CECL. Credit risk is real, but CECL will help us define credit risk in a way we probably should have been doing all along, which is looking forward. It helps us assess the credit risk we're about to book on the next loan, which is exactly the question we're trying to answer when we price a loan. What is the credit risk we're about to add for the next loan? Not what do we have on the books today. So CECL is going to be our best solution there. Now we have this thing called option risk, which is the industry's definition of the fact that prepayment behavior means your cash flows are going to change, your income is going to change. It's going to have an effect on income overall, and you need to hedge this in some way. That's a really hard thing to figure out by looking at your balance sheet. But we have industry data that can help us there a lot. So I tell people not to worry too much about that because we can make some estimates of option risk and get some pretty good measures. Then we have this thing called interest rate risk, which a lot of you know is real because a lot of you have policies that say we're not going to make this particular kind of loan because it has too much interest rate risk. So I need to shorten what is probably a 30-minute discussion into a couple sentences to describe what this is relative to loan pricing. So I'm going to give this an attempt here. Here goes. Try 2 sentences. I think I can do this. The cost of funding the next loan should not be determined by looking at your current cost of funds, because your current cost of funds is going to change. Wholesale borrowing curves, which by the way are readily available, give us a very clear picture of what the market thinks we have in terms of future interest rate risk. And that's what we can and should use when we're pricing loans. So actually that problem has a very easy solution burden if you use what is called an FTP-based model. What that really means when we assess interest rate risk, we really don't even look at our own institution cost of funds. We look at the market assumption about what they think those costs are going to change. So that has a relatively straightforward solution. Whoops, sorry about that. Okay, so back to my initial discussion. I showed you the differences in those institutions for a reason. When I look at loan pricing in practice, I see 2 basic approaches represented on this slide. One I see is what I call a comfort zone. I define a comfort zone as, look, this is how we've been doing it for a while and it seems to work for us. Okay, I got you. And that's my opinion, those bullet points on the left, my opinion about what I see going on in the comfort zone. What do I see in what I think are successful institutions? Do I see the best rates being paid? Do I see really low loan losses? No and no. Do I see really high growth rates? Sometimes, but not always. What I see are represented by those other 3 bullet points. I see a consistent approach to assessing the real risks that we're pricing in loans. I also see an approach to relationships, which I'm going to share with you in a minute. I also see institutions that focus on what they're good at. Now, you have to diversify loan portfolios, but there are things you are better at than other things. And successful institutions figure that out. And everyone who does this successfully, in my observation, has really good measurement systems for figuring this stuff out. By the way, the people that ask us for help at Abrigo and our advisor group in particular on loan pricing are always coming from the left group. They basically admit to us, yeah, we're kind of in this comfort zone, which we sort of understand and we sort of get, but we're not really happy with it. We think we can improve on it. Now, back to that difference in 2 institutions. There are 2 reasons an institution earns more than a peer in their loan yield. There really can only be 2 reasons. They either take more risk or they get paid better for the risks they're taking. What do I mean by the former? Okay, it's possible you earn less yield than a peer because you've got a lot more consumer first mortgage, single family mortgage loans in your portfolio. And by the way, those are a commodity. Commodities have thin margins. Commodities have less overall risk because they're better understood. We know the credit risks of those very well. The mortgage loan gets paid off first, so forth and so on. So that's one reason. That's you're taking less risk. But the other reason is just as important. Institutions who can figure out what risks they're taking often get paid better for them. My grandfather used to say, one of his sayings that I loved as a youngster learning about how the world worked and business works was, anyone can sell $1 for 95 cents. And I think that statement is so true. It is so easy to do that in our industry if we're not paying attention. And that's something a loan pricing methodology can really help us out with. Okay, chapter 3. How does this really work in practice? Well, first, let's recognize that once we put a model and assumptions and get some of this stuff in place, we do have some objective measures to work with. I've been just kind of skirting around this. Let me run through those real quick. These are the 3 most common measurement methodologies that are used in modern loan pricing systems. Investment benchmark, which is, I'm going to show an example of this one in a few minutes. Basically, that's saying if I can either make the loan or I can leave the money or put the money in the investment portfolio, how do those 2 alternatives compare? So we can look at that. We can calculate the market value of loans with modern systems. We do that very similar techniques and finance mechanisms to how we do it in our institution analysis, our asset liability tools, our value at risk calculations we do in AL models are doing market value calculations. We can do the same thing on a loan by loan basis. We don't use that method as often. By far the most common is the third, an income method. We calculate an ROA and ROE of a loan. We go back to that approach I showed you a couple slides ago. We calculate income, we estimate and calculate, costs and expense, and we come up with some kind of measure. How much income will that thing produce? Okay, so those are the basic measures we have to work with. Now, what do we do with that? Why do we have different measures? One of the things I like to point out all the time when people start to look at putting a more systematic methodology in place is this: a loan model does not tell you what rate to charge, because it can't, because it doesn't have all of the information that goes into pricing decisions, such as what's going on in your market, what's demand and supply. It doesn't have that. What it does is it tells you what the relative differences are between different types of loans. So we have these different measures. You see the list there on the right. What do I do with these different measures? Well, part of the answer is it depends on what your institution situation is. Back in 2010, for example, a lot of us had serious capital concerns. We had lost capital. We had loan losses we were trying to recover from. We had capital rates that were getting dangerously low. Regulators were concerned. At that time, an ROE measure, in other words, I want my loans to earn a certain ROE, was probably the most important measure, and it's the one we focused on the most at that time. Today's different. Today, people have a lot of liquidity, and that ROE measure may not be as relevant today. So institutions, when we go through advisory strategy sessions, we develop guidelines with institutions about what we think the best measure might be useful today. But then in practice, what institutions do is set those, revise those, and adjust those as necessary. All right, so to illustrate this better, let's use real examples, because this always works better. So let's paint the picture of what's going on today. You're all familiar with dealing with some or all of these issues right now. Rates are low, loan yields are low, our net interest margin is going down. Competition is fierce in a lot of places, in most markets, because everyone has this excess liquidity. How in the world am I going to keep making loans when people keep coming in and refinancing and paying this off? Home equity loans have been paying off over the last year. Like I mentioned earlier, credit card loans have been. So that's creating pressure. We now have this CECL thing to deal with. That's changing the way we evaluate and actually have to book credit risk, because we now have to say, we think this loan might lose money in the future. Doesn't matter what happened in the past. CECL says, so we've got to book a credit loss today. That's changing how we evaluate things. So that it changes the way I look at my whole credit risk and credit spread thing. So how do we do all this? I'm going to walk through some specific cases here. Let's start with excess liquidity. Here's a very real story I deal with all the time. So the example here is you're out there making a traditional commercial, let's say it's a 320 balloon loan. and you have your kind of market rate you've been able to get and renew at, and then you discover that your market has dropped down to 3.1%, which a couple years ago would have been unthinkable. Even now, I have a couple lenders who say we're not going to make these ridiculously low price loans. I say, well, Gene, what do you consider ridiculous? Well, 3% loan for commercial real estate is ridiculous. Well, why is that? Well, here's the thing. There's people out there making them, and they're making them for good reasons. And here's the analysis that supports that. If I have liquidity, if I've got 35% of my earning assets in investments right now, I can either book this loan or I can repurchase the investment. Now, we have investments right now rolling off the books at 2% and getting rebooked at 50 basis points. So this little chart on the right shows a breakdown of how we do an investment benchmark analysis of making a loan. We say, all right, well, we can certainly beat 50 basis points with a loan, but loans have risks and costs. We have an 80 basis point credit adjustment on this particular category of commercial balloon mortgages. We have 67 basis points of expenses we need to account for. So we actually need to beat 1.92%. Well, guess what? At our ridiculous market rate, we are 117 basis points better off making the loan than we are leaving that in the investment portfolio. This is a very real analysis going on today. There are lenders out there, there are CFOs out there today saying, please make those loans. I do not want to rebook this stuff at 60, 80, 90 basis points. Oh, I can extend yield on my investments to get maybe 1%, right? By the way, this analysis does take into consideration interest rate risk, credit risk, option risk. What it does not consider is funding cost, because in this analysis, funding cost is irrelevant. We've got plenty of this funding. So this exercise is going on all over the place right now, and institutions are looking at growing loans in sectors or rates that they wouldn't have considered a while ago now that they have all this liquidity. Now, second case, let's deal with one of the big elephants in the room right now, which is, yeah, we're in this low rate environment, but it's going to go up. And when it goes up, we're going to make more money, right? That was the mantra back in 2012, 13, 14. We're just waiting for rates to go up. We're going to make more money. Well, and we can't make these ridiculously low rate loans forever. So we're going to keep everything short. And a lot of people who employed this thinking back in 2013, 2014, 2015 made mistakes that we can document today by going back and saying, here's how much you lost by assuming rates were going to go up sooner than they do. So what is going to happen with rates? Well, here's what the Fed thinks. The Fed's indications right now says we're about here, 2023, 2024. We might, we've got the easing thing going, that's maybe going to start in September, but that can change, right? Because maybe this happens sooner. Maybe this blue indicator moves to the right if inflation goes up faster and the Fed reacts faster. Maybe COVID variants become a problem and the economy slows down a little bit. Maybe this blue thing moves back a little bit because it's going to be 3 or 4 more years before rates go up. We don't really know. But let me lay one more piece of information into this. This is the length or the duration of a typical 520 balloon loan, your classic commodity commercial real estate loan, laid into this analysis right here. Now let me define duration for a second, just so we're all clear on that. The duration of a loan is the weighted average life of the fixed rate cash flows that we can't reprice, okay? So the duration of a 520 balloon loan is not 5 years, it's less than that. The duration of a 30-year fixed rate loan is not 30 years. It's actually around 6.5, 7 years, depending on our assumptions about how it may prepay, how often, what percentage of those will prepay. So when we make a 30-year loan, it's not 30 years of cash flows. When we make a 5-year loan, it's not 5 years of cash flows. It's less than that. Measuring the duration differences in loans is very, very important to measuring the amount of risk we're taking on, in particular, interest rate risk. So this is where I've seen mistakes made over and over and over again in the past with crude measurement terms or measurement mechanisms, because we're not effectively evaluating the real risks we're taking on. So let's look at this in an actual example. Let's take this case that I run into all the time with commercial lenders who say, well, we want to make a 320 or a 520 balloon because that's what we do. Well, what if the borrower wants a 7-year loan? Because guess what? Borrowers like a little bit more certainty, and they are also often, or usually, willing to pay a higher rate to get more security on that. They're managing their own interest rate risk, right? So, you know, institutions often say, well, we just don't make 7-year loans. It's not in our policy. We only make the 5-year loans. Well, I'm saying, what if you did? If you're using a modern loan pricing methodology, we can calculate exactly how much interest rate you're taking on. In fact, in this analysis, if I go to 4.1% on this loan, if I think I can get that and go out to 7 years, I'm actually going to do better. I'm going to earn a higher ROE. And this is some real data from an institution that's got real assumptions. This isn't made up to look good. This is a database I use for this analysis that's based on some thoughtful analysis of what our credit risk, option risk, and interest rate risk is in these loans. So what I did was I more than covered the additional interest rate risk I have in making that loan. Now look at the duration difference. This is really important. The duration of the 320 balloon is 2.5 years. The duration of the 720 balloon is 4 years. That's a 2-year difference, not a 4-year difference. Okay, so that's where risk management, precise risk management becomes important. Now, what a lot of you do, and have been doing for years, is saying, well, we do offer a 7-year fixed rate loan to this person. We do it via a swap. We go out and we help them purchase a micro swap. And they pay fixed and we get floating. But guess what happens in that scenario? So using I took a recent analysis, a recent swap pricing curve when I did this analysis. I said, all right, to give that same borrower 4.1 fixed rate, we have to implement a swap based on 3-month LIBOR with a credit spread of 298. What happens in a swap is you give up income today to reduce your funding costs. In other words, you're getting paid variable, and that's going to go up when rates go up. If rates never go up, you're going to earn less on this. You're going to earn 898. And keep in mind one other thing. We've accounted for the additional interest rate risk already in these 7-year loans. So here's a use of pricing methodology to make decisions on loans you maybe don't want to make or maybe don't want or don't know how to analyze. One of the things that's always bothered me about institutions that implement swap strategies for managing risk is that they've been doing it with tools that are too crude. And what I mean by that is they analyze this at the institution asset liability level, not at the loan by loan level, which is where it really needs to happen to make the best decisions. Okay. Now, this is a quick example of an alternative way of dealing with credit risk. I pointed out it's really hard to come up with the credit risk assumptions, as the burden of that can be relatively high. We have another way of doing that by using ROE as a measure of the return of a loan. And because what we can do with ROE is we can allocate more capital to a category of loans if we don't know what the loss differences are going to be. So the scenario here is we want to move into, let's say, a class of commercial loans where we're not as confident. We think the loss numbers are going to be what we project, but we're not as confident, so we don't know how much more to ask for in rate. Now, a lot of you have been through a scenario where there's opportunities to grab market share from competitors because you can make loans they don't want to make because they think the credit risk is too high. And so you go out and you purchase poorer credit risks by offering a rate that's lower than maybe it should be. Well, we have a different way of addressing that by using an ROE method. And I'm not going to go into this one in a tremendous amount of detail because there's too much math involved and it takes a little bit too long. But the point here is with loan pricing methodologies, we have additional tools to help us assess how much credit risk we actually might be taking on and how to manage those risks. Now, I want to talk about relationship pricing for a second. Because this is an important tool that I think is used in high-performing institutions. When I see there's a lot of systems out there that attempt to calculate product and customer profitability. And I don't like a lot of them because most of them look out the back window. First of all, they're not forward looking, they're backward looking. But they have a bigger problem. They try to answer a question I think's the wrong question. They try to say which customers are profitable. And here's the problem with that question. Your customers are not unprofitable. You are selling unprofitable products to some people. Sometimes you have to do that. Every industry has loss leader types of products that they have to do. So we can use relationship pricing tools in a loan pricing methodology to say, all right, I realize that 520 balloon is a commodity product that I'm not earning as much on, but can I make the relationship profitable? And let me just quickly cover the example at the top. I can't get the balloon loan unless I'm at the bottom of the market, but the borrower agrees to keep their 150 line of credit with us. We're pretty confident it has an average utilization that keeps the average balance around 100,000. Guess what? That's a relatively profitable loan. That relationship is much more profitable than the unprofitable loan. So this is a tool and a mechanism that I think is very important, very useful, and helps us deal with that whole profitability question. It helps us answer the correct question. We know we have profitable and unprofitable products. Can we put something in place that keeps profitable relationships with us? Now, page 26, I'm not going to talk about too much today. There's various issues in relationship pricing I'm sure some of you have dealt with over the years, and we're glad to talk about those or answer questions about that in more detail. One last quick topic on pricing. All of these concepts, I've been kind of using commercial loan examples. These concepts all apply to any kind of lending that we're doing, even if it's portfolio or what we call rate sheet lending. The example on this page addresses a question that I like to bring up with anybody who's keeping a significant number of, let's say, consumer mortgages on their portfolio. And what I try to get them to do is to look at the value of those loans on their balance sheet, not the value according to the market. The problem with the mortgage market, it is heavily influenced by the secondary market, the purchasers, the buying and selling, Fannie Mae, Freddie, the 10-year Treasury, and the fact that everybody looks at the 10-year Treasury every single morning before 7:55, they know what it is, and they're going to change their mortgage price in that day. That can, jerk the pricing of these along. Well, if we're going to keep these on our portfolio, we need to measure them based on our balance sheet, not based on what Fannie's pricing is today or their pricing indications if I'm not going to sell it. When we do that analysis, we discover that there can be significant differences in value to us of those loans. And I may prefer one or the other once I understand these differences. Every time I do this analysis, 30-year loans generally come out better than 15-year loans at current market rates, market being defined by Freddie Fannie. So here's a perfect example of how we cannot let markets always influence the decisions we make on what we're going to portfolio until we measure it against our own assumptions in our own balance sheet. Okay, so to wrap this section up and get to my last topic, so I leave some time for questions. I said earlier that loan pricing models don't tell you what rate to charge. They tell you the differences between different types of loans that we're making. So to us, effective loan pricing is really illustrated in this page right here. Let's figure out what's well priced. Let's figure out what isn't. Let's figure out what we're good at. Then let's set guidelines based on that knowledge and make better pricing decisions once we have that kind of knowledge. There's some industries that with some of my clients seem to do much better. They seem to produce more profit. It can be something as simple as one subset of commercial lending be more amenable to fees than another. Maybe competitors are all discounting fees this year. So you lean away from those loans because if I'm getting fees on a regular basis in another sector, that can dramatically boost my returns. That's what we do with loan pricing models. We look for those differences and segregate loans that way. All right, last chapter. How do we know if this is working? I said all good performing institutions measure this stuff. And I'm going to touch on 3 ways of looking at this that you should use, or you should try to use some version of if you want to get better at this. The first thing I've already introduced. I've already introduced this concept of comparing yourself to peer. because frankly, we have institutions out there that are justifying their efforts, their costs on improving this one metric. It can either be net interest margin relative to peer or yield of loans relative to peer. They know their peers, they think they're making about the same kinds of loans, so they look at this number and try to make this number better. But the problem with this number is it's a call report number and everything is blended together. So you need to go one step beyond this. You need to start to break things down and look at what you're originating and what you're yielding off of what you're originating by as many categories as you have time and effort to break down. Anywhere there's real differences in costs, risks, marketing efforts, activities, we want to break those numbers down and start tracking them. So here's a quick picture of, this is generically how we do this. In reality, this data is a little bit more detailed, but the concepts here is pretty simple. If I can track origination activity in volume and yields and fees by these different categories, I start to learn more. I start to learn more about where I'm making loans and where I really am getting yield. Starts to shed light on that earlier question. And then finally, well, I'm sorry. So that's the generic picture. Here's a quick real world case. This is one of the clients I work with. These are the different categories that we go in and we break out. We get all the cash flow differences, the credit risk differences, the costs, and so forth. We break them all out by these, and then we track all the activity by all these categories. So if you're not already doing this, imagine if you could come in and say, I know exactly how much yield, fees, and originations I'm getting by this level of detail. Then we can start answering questions about why we maybe aren't doing as well on loan yield as peers, or where we can improve things, or where we prefer to make more loans. Last thing I want to show you is what kind of sums up this point I've made a few times, which is loan models tell you what the relative differences are between loans. Here's a performance chart we use, and I happen to be showing consumer loan categories here, but you can do this with any category. This institution uses an ROE standard to measure relative values of loans. And what this picture shows us is a real-time snapshot of what the most recent origination activity is earning in terms of ROE as measured by a loan model. So the bar at the line at the top, which is home equity loans, are earning the most returns. The line at the bottom, which is mortgages, are earning the least. That's not real surprising. Mortgages are a commodity. And this is something we can do once we put mechanisms in place. We can track these differences. We can see where we're earning more, when and where we have choices when we have this data. Okay, I'm going to turn things back over to Thomas to wrap things up, and then we've got some time for questions. You get paid to take risks. As an industry, we have a lot of guardrails around that, major things like capital, and industry concentration. But within the lanes of what we're driving on, we have a lot of choices. So to have a high-performing loan portfolio, you need to be able to document and discriminate between these things and describe what risks you're taking, and then get paid for them, right? Get paid the best you can for them. Loan pricing obviously helps us do that. And this is easier said than done. So like I said, I've already indicated that figuring out what you do well is an important part of this process, because it helps shed light on where you can maybe apply more effort or make some changes in overall pricing approach. Now, how do we justify this effort? I would start by simply making sure as you go through and improve this practice that you coordinate these efforts with what is already going on in two key areas: asset liability management and CECL. CECL, again, is how we're going to be moving forward and evaluating forward-looking credit risk. So you're going to be doing a whole bunch of work there. A lot of that same work translates right into that assumptions burden I mentioned earlier. Now, in asset liability management, which I define as the institution level income and interest rate risk that we're trying to analyze, there's always been this disconnect between high-level strategy and daily decision-making in the form of a loan or deposit strategy. But we're really analyzing the same things, and guess what? We're using almost the exact same tools. We're just using them as a different level of resolution. So I'd encourage you to keep looking at ways of coordinating these efforts and sharing all this information. When people ask me how much it costs to do a better job of this, I point out that the people that pay us to do it whether it's as advisors or using our software or some combination of all of the above, usually ends up being about a basis point of net interest margin in terms of what we end up, the out-of-pocket costs for that effort. So with that, I'm a little bit over my time, but I think we've got a few minutes left. Thomas, I'm going to turn it back to you. You can grab the presentation for me, correct? And I'm going to look through the questions as you wrap things up for us.
Thanks, Daryl. I've got it.
Okay.
So I think what we'll go ahead and do here real quick before we jump into those questions is we'll launch a quick poll question, and really just Daryl just mentioned that we've got a lot of clients that are utilizing our software or also utilizing Daryl's, mine, and others on our advisory team to help them out. And so would love to get, if there's something we can help you with, whether it's more on the software side or on the advisory side, but we've got a poll question up on your screen now, making more informed pricing decisions, maybe helping you with a little bit improved underwriting efficiency, or maybe it's talking with somebody in our advisory team and helping you kind of tailor an effective pricing program, kind of similar to some of the stuff that Daryl alluded to today on the presentation. So I'll leave that up here for a few more moments while I let you take a look at that if that's something that you're interested in. While we leave that poll question up for a few moments, Daryl, I know we got a couple questions that came through.
Let me go ahead and answer the two that I see here. There's a couple of really good questions. Question number one, yeah, finance wants us to use reserve allocation as our credit risk assigned to new loans. And it's way too high, and I agree with you. How can I argue against that? Okay, I would start number one, point out that what we're trying to do in assessing loan profitability is look for differences between loans. So I would actually use nothing before I would use the across the board reserve allocation number for loans. It's backward looking and it doesn't give us any information about what differences are between loan categories. I would, you could do a better job of, you could go online, you could go to the Federal Reserve Bank of St. Louis and look through all the data they have available, and you could actually get estimates of current delinquencies and how much they vary by mortgage loans, consumer loans, credit card loans, commercial real estate loans. You could do a better job with a napkin, jotting down notes on a napkin of coming up with credit loss estimates that are better than the reserve number that you're currently using. For example, a real common number I'll just throw out there is a lot of institutions use a 25 to 30 basis point loss assumption for first mortgage consumer retail loans. They add to that if it's a jumbo loan. They double that if they get into consumer loans, such as auto loans and so forth and so on. So you can do a better job with intuition than you can using that number. And those are the arguments I would use. But I would start with argument number one, which is it tells us nothing if we use that. It doesn't get us any closer to solving this problem of figuring out how to price loans. The second question I got was, could you explain retail benchmark spread? Sure. The retail benchmark spread is actually a discounted cash flow analysis that says, if I take the cash flows from a loan, and by the way, I need some information about how the loan's going to cash flow. So let's say it's an amortizing loan. I'd amortize a 5-year amortizing loan, simple, 5-year C&I loan that's going to amortize fully over 60 months. That has certain cash flows. I get interest and principal every month, right? They don't all come due in 5 years. What we do with the retail benchmark analysis is we take those same cash flows and say, mathematically, we don't actually do this, but we buy laddered investments. We say, what if I buy 1 month security? What's the short-term rate? 2 month, a 3 month, and then I end up buying a 36-month security. We can do this in math. We can look at the yield curve of current investments and figure out exactly how much we would earn if we bought a series of laddered investments that match the cash flows of the loan. So that gives us the exact same interest rate risk profile and earning potential of that loan if it's in the investment portfolio. Then we have to add on top of that what we think it costs us to make the loan. So we think maybe it costs us 60 basis points in operating expenses. Maybe we have 50 basis points of credit loss assumption. We have to add those on top because we theoretically have no credit losses if we purchase the investment. So we simply do that slide, that page 22 or whatever it was, somewhere near there. That chart you see on the right is very simple math. It's simply taking the investment benchmark number, which is that laddered investment number, adding those other numbers to come up with that hurdle. And then we just simply take the yield of the loan. The yield of the loan may be interest rate plus fees, whatever that is. If that clears that hurdle, then the analysis says making the loan would be better than the funds sitting in the investment portfolio have if we make the investment today.
Awesome, thanks, Daryl. And yeah, great questions. Thank you so much for the participation. We enjoy those sometimes more than we do the presentation itself. Well, I know we're right up against time here, so just a few more items I wanted to run through real quickly. As far as additional resources go, we're putting out blogs and checklists, white papers, and other webinars all the time at Abrigo by folks like Daryl and Dave Cook and a few others on our advisory team. And so I've got a few of those resources linked in the slide deck. We've done some recent business lending surveys to get some results there. And we've also got some blogs on loan pricing, community bank and credit union outlooks, that sort of thing. So feel free to go on our website and check out any of those resources. And then finally, we just wanted to thank everybody for joining us this afternoon. Like I mentioned earlier, you'll be receiving an email from me either later today or first thing tomorrow, and you'll get the slides and a recording of the presentations that you can share around with any other of your colleagues. If you have any other questions at all, please don't hesitate. I'll flip back to that slide real quick, but this has Daryl's email on it. I know he'd love to answer your questions. So thank you so much. And Daryl, thank you for your time as well.
Well, thanks for everyone's time this afternoon. And again, yeah, feel free to get in touch with us with follow-up questions. I enjoy hearing your questions and glad to respond to them.
Awesome. Well, have a great day, everyone, and we hope to see you on another webinar soon.
Thanks, Thomas. See you later.
See ya.